The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with Booz Company partner, Justin Pettit, about the mergers and acquisitions market and his recent Strategy and Business article, Making the Most of M&A. This is episode 7, and we'll be speaking more with Justin about value-based management and the continued relevance of shareholder value-based performance measures. As we noted during the last episode, this two-part series of episodes marks a modest departure from our normal programming and also appear on our companion program, CEO Talk Radio. So Justin, welcome back to CEO and CFO Talk Radio.
Thank you, Robert. Thanks for having me here.
Well, again, we're really happy to have you again for this second episode. And with, during this visit with us, I'd like to turn our attention from M&A to talk about value-based management. And you're currently a partner at Booz Company, but during a former life, you were a partner at Stern Stewart, which, for those who are not familiar, really popularized the concept of economic value added at a number of large corporations, probably some of the best well-known, Coca-Cola, Briggs, and Stratton, and many others during the 1990s. And I really got to ask you, what in the hell happened over the past 15 years or so? I mean, it seems more often than not when the general public, when they refer to shareholder value, they spit it out with the same venom usually reserved for mass murderers, dictators, or the Ebola virus. So what happened?
Okay, well, Robert, I'm happy to report shareholder value is still alive and well. Still the compass for many executives that I worked with anyway, 15 years ago. Great companies like Herman Miller, Hertz, and Halliburton. But yes, there was a dark period where its use was in decline. And in fact, I believe Jack Welch has described shareholder value as the absolute worst idea ever in the history of management. So we've got that to work from. As you talk about in your own book, corporate initiatives do tend to have a bit of a life cycle. First, they're embraced as the panacea to cure all problems and boost your share price. And then when they fail to live up to these expectations, they're cast aside in favor of the next big idea. And let's not put all the blame on the executives. Management consultants and management gurus are equally to blame for helping to set these unreasonable expectations in the first place and for catering to the Fat of the Month Club in order to fuel a vigorous speaking engagement schedule and sell more books. And of course, finally, the publishers and the media make their living by fueling the frenzy for the next big idea, which leads to what I call executive ADD, which undermines successful initiative execution. But moving beyond the blame game, I think the problem isn't unlike the problems with M&A. It's often not the concept itself, but the execution that fails, and ultimately it's easier to reject the entire initiative than it is to address the root cause and to fix it.
Okay. Well, let's take a moment. We'll step back and maybe define value-based management for listeners who may not be all that familiar with the idea. And in my mind, it's nothing more than managing the business and its assets in a way that ensures that profits are sufficient to reward equity holders at some minimum acceptable level. And, as we know, most stakeholders are represented on the traditional income statement, employees and lenders. But there's really no line item on a traditional income statement that represents the cost of equity. And absolutely no one, whether it's your mom, it's your grandfather, or whether it's an institutional investor, is going to invest in a stock or a mutual fund, and particularly in this volatile climate, unless there's some reasonable assurance of a minimum level of return. Am I off base, in terms of my view of VBM? How would you care to explain it to someone who might be unfamiliar with it?
I like the analogy to family investment strategies, but I'm really not sure what drives my own father's investment decisions. But yes, I think that's right. I think that's a good way to think of it. I tend to think of it in terms of intrinsic value, pretty much the Warren Buffett perspective, and for folks who can relate to NPV as a proxy for intrinsic value, then it's really just all about managing your business so that the changes in NPV are a nice big number. And then sort of moving beyond NPV ultimately to something that's a little more operational for day-to-day business operations, or for folks who don't maybe think in terms of NPV, like a shopkeeper. It's really getting to the point where you're managing your business to generate more cash than you would if you were to simply sell the business and live on the investment income.
Okay. So now that we've defined it, how can we advise CEOs and CFOs and, the senior corporate finance team to best manage it? And in managing it, does that mean that we somehow shortchange other stakeholders at the benefit of equity holders?
Okay. So let me take those two questions separately. First, the managing it, and then secondly, what about the interests of other stakeholders? On managing, I think those who are most successful try to live it. And the way to live it is to institutionalize the notion that every employee should think like, act like, make decisions like an owner. All too often I've heard managers tell me that they do things that don't make good business sense, things that they'd never do if they actually owned the place, because that's what their incentive scheme is rewarding, or that's what the accounting numbers are telling them to do, or because that's what they believe Wall Street wants them to do. I talk to Wall Street guys several nights a week at my son's hockey practice, and this just isn't true. It's simply not what they would want you to be doing. But that's how it pans out. In terms of the interests of other stakeholders, capital is a scarce resource, and all businesses must compete for and efficiently manage capital because it's a limited supply and there are liquid markets. Capital requires that users maximize its value or face a flight of capital to more attractive opportunities. So this doesn't need to imply a conflict between the interests of employees and customers with owners and the managers who act as the stewards of our own personal savings. Managing for value just directs our scarce resources to their most promising uses and their most productive users. And so the more effectively our scarce resources can be deployed and managed, the more robust will be our economic growth and the rate of improvement in our collective standard of living. So it's all motherhood and apple pie. It's good stuff.
All right. Well, I'm going to take the listeners kind of down into the weeds of finance for a second. And if you wouldn't mind, talk specifically about capital structure, essentially the amount and ratio of debt to equity that a company uses to finance its assets. And traditionally, there's always been a preference for debt, since the after-cost tax of debt has largely been viewed as much less expensive than equity. But given the volatility and the volatile nature of the global economy, we've seen over the past decade, not just simply the last 5-6 years, and probably will continue to face. I think an argument can be made that companies really need to maintain a higher level of equity in order to enjoy more financial flexibility to weather the inevitable ups and downs. And assuming that you agree, and again, feel free to disagree, but what's the impact of carrying more equity, than we may have, in the recent past?
Sure. Okay. Well, I think I agree. I don't think you're off there. I would break it into maybe two key drivers. When I think about capital structure, it's not only the financial leverage, but also the liquidity. And although liquidity and leverage are somewhat linked, they are two independent drivers of capital structure. Liquidity being the amount of cash they're carrying, and the leverage being the amount of debt they're carrying on the opposite side of the balance sheet. In many cases, what we're seeing right now is capital structures being maintained with both less leverage and with more liquidity. And that's for today's market, and maybe this will change as volatility wanes and as market access is again assured. But for now, that's what we're seeing, and I believe that's rational in light of the recent economic turmoil. And then there's a second driver beyond the economic crisis itself, and that's the rate environment. Really, when you think about NPV terms, the opportunity cost of being overcapitalized is much lower than it was in the high rate environment of the 1980s. If you run the numbers from an NPV perspective, you'll see there's simply much less NPV to capture by levering up a company today versus the 1980s. And so it's not surprising that the 1980s was the real golden age for the traditional LBO, for example.
Okay. Well, before I let you go, I kind of want to return to the first question a bit. I mean, I'll give you my perspective. I mean, first, if it's not obvious to you and the listeners, I'm a strong value-based management proponent. And I think, right now, shareholder value, it's almost a four-letter word for a lot of people. And I think, from my perspective, a couple of things happen. Number one, any negative announcement for a corporation that was going to have a negative, PR impact was blamed on shareholder value. And in my opinion, they could have just as easily used the word profit. And, instead they blamed it on shareholder value. Shareholder value has the word shareholder in it that suggests that, this is the ultimate stakeholder, and that somehow we're optimizing economic profit at the cost of other stakeholders. And the other thing too is, I apologize for lumping you in with me on this group, but we're kind of finance wonks, and trying to explain the idea of economic value added to people in the organization that aren't as wonkish, it's almost kind of a mystical, concept. What do you think?
Well, the key is to make it real, right? To make it operational so that we can influence the behavior of folks throughout the company. Because each of them is making decisions and acting in ways that affect the value of the firm.
Yeah. Well, today we've been talking again with Justin Pettit, a partner at Booz Company, about the much maligned concept of VBM and shareholder value. Justin, I want to thank you for joining us again, for these past two episodes, and for really having the courage to tackle VBM with us today. And no doubt we'll be hearing more from listeners on both sides of the debate. So again, many thanks.
Thank you, Robert.
That was Booz Company partner Justin Pettit discussing value-based management and the continued relevance of shareholder value metrics. This completes a two-part series of episodes featuring Justin, and I'd like to thank him again for sharing his thoughts and experiences. Please join us for our next episode when we speak with Fred Militello about his book, Leverage Competencies, What Financial Executives Need to Lead. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.